Morning, everyone. Welcome to our Phillip Securities Research Morning Call. For today, we have a few stock counter updates, including results from TDCX, PropertyGuru, a few on the ground for NIO, initiation for SATS, as well as an update for Sembcorp Industries. For technical analysis, we have it for Straits Times Index, S&P 500, CapitaLand Investment Limited, Franklin Group, ASML Holding. For macro outlook, we have the FOMC minutes highlights from the Fed. Just a reminder for our last Phillip Securities Research Morning Call, it will be on 12th of December. So just to take note. So without further ado, I'll hand over my time to Jonathan to talk about TDCX.
Thanks, Ian. So I'll be running through TDCX's third quarter 2022 results with a report titled Muted by Macro Uncertainty. So just a brief kind of introduction. TDCX is actually an outsourced CX company, so customer experience company. Most of their clients are your new economy clients, which are basically your high growth tech companies. In terms of results for the third quarter, TDCX actually recorded 173 million Sing dollars in revenue, representing about a 16% year-on-year growth. For PATMI, they generated about 31 million, which is only a 2% year-on-year growth. But one of the main reasons for this is because they actually implemented a stock-based compensation program in the fourth quarter of last year. So it wasn't actually present in the third quarter. So if you strip that out, you strip that expense out for this year, adjusted PATMI was about 35 million compared to, which essentially is a 15% year-on-year growth. So much more in line with revenue. In terms of year-to-date revenue and PATMI, it came in at 73% and 84% of our full year 2022 forecast. So just the one positive for this earnings call, and that came from travel and hospitality verticals. So this I guess the rebound in this sector is actually providing most of the growth tailwinds, and rather provided most of the growth tailwinds for the quarter. So this number actually, revenue from this vertical actually grew 29% for the third quarter of 2022, and it's actually returned to pre-pandemic levels. And most of this was boosted actually by higher contributions from existing clients, and also new revenue from clients added over the last several quarters. So we also think that the potential reopening of countries in North Asia, especially in China, Japan, should provide optimism for further growth in this vertical moving forward. Travel and hospitality remained the company's second largest vertical in terms of revenue contribution. In terms of the negatives, we're actually seeing revenue growth decelerate sequentially. So 16% year-on-year for this quarter, compared with 27% in the first quarter of this year and 24% in the second quarter of this year. There are several reasons for this. Obviously, the biggest reasons are inflationary fears and a significant pullback in spending by a lot of their tech clients. We do think that in terms of guidance for the fourth quarter coming up, we do expect this to be only around 13%, so to continue this downward trend. And how we get this is we just take the midpoint of the company's guidance, and you subtract whatever revenue that has been generated over the last 3 quarters. The second negative is that adjusted EBITDA margin is actually down 4% year-on-year, almost 4% year-on-year. And this is if you take out the share-based compensation that didn't occur in the third quarter of 2021. There are several reasons for this. Firstly, there was a significantly higher business volume in the third quarter of last year compared to this year. There was a catch-up revenue reduction relating to a warrants agreement with Airbnb, which is one of their main clients. Thirdly, the TDCX actually saw increasing corporate overhead costs, mainly due to business expansion into different regions, so they had to hire significantly more senior management. And lastly, there was a 30% higher employee benefits expense year-on-year, mainly due to an increasing demand for talent globally, as well as inflationary pushes. So in terms of their year-to-date adjusted EBITDA margin just came in at 31.4%, so largely in line with the company's guidance of 30 to 32%. This is their guidance range for the full year 2022. In terms of outlook, TDCX actually narrowed both their top and bottom end ranges for full year 2022 revenue guidance. Taking this into effect, the midpoint still remains unchanged. At the same time, the adjusted EBITDA margin forecast of 30 to 32% remains unchanged. There is some sort of uncertainty surrounding revenue growth for 2023, especially given a lot of cost-cutting initiatives by your large US companies globally. So it's a bit uncertain as to how that will play out moving forward for next year, especially with sort of recession fears increasing and recession becoming a bit more certain for at least, I guess, 2023 or 2024. In terms of valuation, we raised our 2022 PATMI by 12% to 108 million Sing dollars, primarily due to higher than expected interest and other operating income, while keeping 2022 revenue unchanged. However, we do cut 2023 revenue estimates by about 5%, just predominantly based on just a weaker macro environment and uncertainty surrounding these cost-cutting initiatives. We maintain a buy with a reduced target price of $15.50 US dollars, with a weighted average cost of capital of 10.4% and a terminal growth rate of 3%. So that's all for me. I'll pass my time on to Max for PropertyGuru.
Thanks, Jonathan. So PropertyGuru also announced their third quarter 2022 results last week, and we have published a report with the title "Cooling Measures to Affect Growth." Next slide, please. So overall revenue was in line with our expectations, but its earnings missed. So 9 months total revenue came in at 66% of our full year 2022 forecast, but the 9 months total adjusted EBITDA and net loss came in at 30% and 135% of our forecast. And this is mainly because of the higher than expected employee expenses as well as other expenses. Just as a brief overview, revenue grew 47% year on year to 34.6 million. And net loss came in at 7.4 million, which decreased from the 9.6 million loss in the third quarter of 2021. So moving on to the positives. Firstly, PropertyGuru's core marketplaces business continued its strong year-on-year growth, with revenue growing 48% year-on-year to 33.3 million Sing dollars. And this is on the back of this is mainly because of the jumps in both Vietnam and Malaysian market. So Vietnam revenue actually spiked 161% to 6.2 million Sing dollars. And this is mainly because of the favorable comparison against the year ago period, as well as the easing of COVID-related restrictions in the country, with the number of listings also surging 165%. And revenue from Malaysia also jumped 49% to 6.5 million. And this is attributed to the acquisition of iProperty in Malaysia. And then for the Singapore market, it remained as the largest revenue contributor, growing 28% to 18.1 million. And at the same time, during the quarter, PropertyGuru was also able to attract 300 new subscribers onto the platform when compared to the second quarter. And then for the second positive, PropertyGuru was able to increase its monetization of its agent customer. The average revenue per agent, or ARPA, in Singapore actually rose 24%, while the average revenue per listing in Vietnam increased by 2.5%. And during the quarter as well, the PropertyGuru was able to achieve a high renewal rate of 87%, up from the already high 82% in the second quarter. And this is despite the fact that the company increased their prices by around 15% on average that took effect in September. And then during the earnings call, the company also says that they are expecting to raise their prices in Malaysia in December as well. And then as for the negative, PropertyGuru mentioned that the cooling measures implemented by the government is going to weigh on the growth for the fourth quarter of 2022. And this caused them to revise their FY22 revenue guidance to be between 134 and 138 million, which signifies a 33 to 37% growth, down from the previous 44% growth guidance. And this is because the increased taxes and stamp duties by the Singapore government, as well as the decreased maximum LTV loan ratios and the 15-month quick period for private HDB buyers. And then Vietnam's credit restrictions for both home buyers and developers are expected to reduce the activity in the real estate market. And then the recent election in Malaysia is also expected to put property market players in the country, including home buyers and developers, on a more cautious stance. So all of these factors combined is expected to affect the income of agents as well as businesses of developers, which ultimately will affect their spending power. Yeah. So as for the outlook, the management believes that the macro headwinds mentioned just now are temporary in nature, and they actually view this as a positive sign that the intervention signals the governments are confident in their respective real estate market, and they are actively taking steps to prevent the sector from overheating, which actually started the property market crisis in China that is happening now. So therefore, our full year FY23 forecast and assumptions remain unchanged. And then furthermore, Q4 is the strongest quarter for PropertyGuru in the financial year based on the historical numbers for FY21. And this is mainly because home sales tend to peak during the quarter because of the absence of regional holidays, such as the Chinese New Year that typically takes place in Q1, as well as Thailand Songkran and the Hari Raya that takes place in Q2. And then during the quarter, they also have the awards business, which adds a portion of the quarter's total revenue. But management has indicated that the awards business does not have a margin that is as high as its other segments. And furthermore, the high sales period is expected to be partially offset by the increased costs, mainly coming from the seasonal marketing campaigns. And then during the third quarter, PropertyGuru actually acquired a company called Sembcorp, which is a Singapore-based company that allows homeowners and tenants to book home services from verified providers through its mobile application. And then PropertyGuru is not expecting a substantial revenue contribution from Sembcorp in FY21, and its guidance has actually excluded the impact from the business. Yeah, so overall, in terms of our valuation, we cut our FY22 revenue by 6% and PATMI by 24%, and mainly to take into account the macro headwinds as well as the increased cost assumptions to better align with the actual results. And then, so all in all, we downgrade to accumulate with a reduced target price of $5.30 with a weight of 10.1% and terminal growth rate of 2%. Yeah. That's all I have for PropertyGuru. Now I'd like to continue on NIO, and this is a Phillip on the ground. So just as a disclaimer, this counter is not rated. So as a brief background, NIO has a market cap of NIO is listed in 3 stock exchanges, including New York Stock Exchange, Hong Kong Stock Exchange, as well as SGX. It has a market cap of around $17 billion, and it is a Chinese premium smart electric car manufacturer. So they recently announced their third quarter 2022 results, and we also hosted them for our guest webinar. So their third quarter revenue actually grew 33% year-on-year and 26% quarter-on-quarter to 13 billion RMB. And this is mainly driven by the growth in the vehicle sales, which grew 38% year-on-year to 12 billion RMB. The vehicle deliveries came in at 31.6 thousand units, which signifies a 29% year-on-year growth from last year. And following that, the company also disclosed that they have delivered 10,000 units in October which goes to the fourth quarter delivery number. So as we can see from the charts on the bottom right, NIO was able to meaningfully increase their vehicle deliveries for the past few years when compared to the respective quarters of the financial year. Yeah. And then for the overall gross margin came in at 13.3%, which is quite a significant decline from the 20% in the third quarter of 2021. And this is mainly because of the reduced regulatory credit sales that has a gross margin of almost, if not 100%. And then it is also because vehicle margins also took a hit and the company's expansion of its power and services network. So vehicle margin actually declined from 16 to 16.4% from the 18% in last year. And this is mainly because of the surge in the lithium carbonate prices, which is the main material for the battery prices battery prices, and battery is the most expensive part of an electric car. Yeah. And then net loss came in at 4.1 billion RMB, which is an increase of 292% year-on-year. And this is because aside from the decline in gross margin, it is also because of the spike in R&D expenses as well as SG&A expenses. And included in the net loss is the other losses of around 500 million RMB. And this is in contrast from the 33 million gain back in the quarter of 2021. The other losses is because of the revaluation of its overseas assets that are RMB based, and the revaluation is because of the depreciation of RMB against the US dollar. So if we take out the effect of these other losses, adjusted net loss came in at 3.6 billion RMB, so which signifies a 242% increase. Yeah. So and then during the call, NIO was asked about the impact of the US Semicon ban on China. So NIO has indicated that the chips that are fitted on board of their cars are not affected, and that they have secured enough supplies of the NVIDIA A100 that is affected by the ban. So the NVIDIA A100 is used by NIO for its AI training purposes, and it says that it has enough supply to meet their needs for the next 2 years. So they believe they are not affected by the ban in the short term. And still on the topics of chips, one of the most interesting points for NIO is that it has a dedicated R&D team that is specifically tasked to develop their own onboard chipset. So the chips design is aimed to replace the NVIDIA Orin chips that are fitted in the cars that they produce. So which means that in the future they may not need to source for these chips from the US suppliers. So this is kind of a similar move made by Apple when they launched the M series chips and silicon chips, such that they don't need to order any more CPU units from Intel. Yeah. And then one I would like to also mention that in October, NIO also launched their product in Europe during the event in Berlin. So that marked their official entry to Germany, Denmark, Sweden, and the Netherlands. Yeah, in terms of the outlook, NIO targets to deliver 43,000 to 48,000 units of vehicles for the fourth quarter, and they are confident that they are able to achieve this despite that they only delivered 10,000 units in October. So they have November and December to reach this target, and they are actually going to release the delivery numbers in the next 1 to 2 weeks. So and then NIO is also aiming to achieve a break-even at the EBITDA level for the fourth quarter of 2023, and they are confident that they are able to achieve this if they strip out the impact of their investment in their battery chipset as well as the smartphone businesses. Then right now the vehicle gross margin is around 16%, as mentioned before, but the company aims to achieve a long-term vehicle gross margin of around 20 to 25%. And this is achievable if the battery prices decline to a more reasonable level. And lastly, they are also aiming to provide an autonomous driving as a service business model, where they sell their autonomous driving capabilities as a separate package to their customers. So they hope that by doing this, they can improve the gross margin of their vehicles as well as the overall gross margin. But it will take some years because it requires a lot of regulation to meet a lot of regulation standards. So that's all I have for today. I would like to pass my time on to Terence for SATS. Thank you.
Thanks, Max, and good morning, everyone. We initiated coverage on SATS with break-even in sight and funding clarity, which we believe will drive the re-rating of SATS. In our next slide, in terms of the investment thesis for SATS, we see 3 main investment theses. The first is that we believe that the funding clarity that SATS has now provided will reduce the overhang on the stock. Since the announcement of its acquisition of Worldwide Flight Services, or WFS, SATS has corrected by over 33%. So the main reason we believe is because of this funding the funding overhang, because they announced a $1.7 billion fundraising, but they didn't talk about the manner in which it will be done. So you can see a very sharp sell-off in the share price. But what they have essentially done now is to cap the rights issue. So if you look at the chart on your right-hand side, you can see that the rights issue it will now not exceed $800 million. And what they have done is, for the placement, this has been converted to a term loan instead of a placement. So this essentially, when you think about this like that, this will reduce the dilution from the rights issue. We model a 3-for-10 rights issue scenario at an issue price of $2.29. So just to be really clear, this 3-for-10 rights issue is not the actual rights issue, but what we do is we just try to think about how they will announce the rights issue, and then we model this into our model. So the model, the 3-for-10 rights issue and the issue price of $2.29 is not confirmed yet. It's just our scenario analysis only. But this $2.29 is derived based on a 15% discount to the last closing price before the initiation of the report. This allows us to arrive at a TERP or extract price of $2.60. The second investment thesis is profitability is now at a key inflection point. SATS is expected to break even in second half financial year 23, with the group turning profitable in FY24. So SATS has been reporting losses because of COVID-19, but we believe that it is now close to break-even point already. And this is driven by air travel recovering to 80% of pre-COVID levels by year end. Last but not least, we like SATS for its strong free cash flow generation and defensive balance sheet. Historically, SATS has always generated strong free cash flow, and for FY24, as SATS continue to reach normalization of its business, we expect SATS to generate free cash flow of $150 million in addition to its acquisition of WFS. This, we believe, will support its dividend payout, which we expect to resume in FY24. Recall that their dividend payout was initially suspended in financial year 2021 and also financial year 2022 because they were not making any profits. So now that they are turning the corner, we believe they will also resume their dividend payout. In our next slide, in terms of the first investment thesis, we believe the funding clarity will reduce the overhang. So what we have done here is to provide an illustrative principle terms of the rights issue. So in this table here on the left-hand side, you can see we provided this potential, again, it's a potential funding scenario with the rights issue price at $2.29. So we put a very steep discount, 15% to the current share price. And then in terms of the allotment ratio, we believe they could announce a 3-for-10. So what is this 3-for-10 means that you will be entitled to get 3 rights, or you can subscribe for 3 rights shares for every 10 held. It could be we also believe that it could be a renounceable rights issue. So shareholders don't need to subscribe if they don't want to, but then you'll be diluted. So you will have 3 rights issued to you for every 10 shares you hold. The total new shares to be issued is 349.3 million, and the ex-rights price is $2.60. Temasek, its largest shareholder with a 39.76% stake, has provided an irrevocable undertaking to vote in favor of the transaction and intends to, subject to the terms of the rights issue, subscribe for its pro rata entitlement. So if you look at the debt to equity table below, naturally when they shift the fundraising from placement to term loans, which we believe was motivated by the lower cost, because SATS has they have a AA, AAA rating because of their largest shareholder, and also because of its stable defensive balance sheet. So their cost of funding is typically very low. So with these term loans, we believe their cost of debt is probably about 5.5%. That's what we model in our model. What it will do is to move their gearing higher up above the level that they're typically comfortable with. So if you look at the table, gearing will move from 45.7% in FY22 to 60.2% in FY23. But we believe that even despite the gearing moving higher, we believe that the group will embark on a deleveraging cycle to move their balance sheet back to being more, to having more headroom to take on more debt. So for FY24 we actually see the net gearing levels start to come down a little bit more as well. So they intend to announce this in November or probably early December already by now. And then conclusion will be of the voting will be in January, and then conclusion of the deal is expected by March 2023, which is the end of their financial year 2023. Our next slide, in terms of the acquisition of WFS, the acquisition of WFS, of course, is expected to accelerate SATS transformation. The acquisition multiple of 9.7 times EV/EBITDA was largely in line with past peer transactions of between 10.1 times and 10.7 times. So it's largely fair. It's not like they underpaid or they paid at the top end of the curve also. So they is largely in line with the historical transactions. But importantly, what SATS has identified, the management has identified meaningful run rate in EBITDA synergies in excess of $100 million. The management expect to realize these $100 million in the next 3 to 5 years for its acquisition of WFS. So in our model, to be very conservative, because this $100 million of EBITDA synergies is expected to just come purely from revenue synergies. So to us, when it's revenue synergies, that's the most a little bit more difficult to achieve than cost synergies, because cost synergies, you just cut a few jobs, you get some synergies already. So that is a lower hanging fruit. But revenue synergies, we believe, is harder. So in our model, when we model the forward financials for WFS into SATS, we actually omitted this $100 million of EBITDA synergies. So what this means is that this $100 million represents upside to our model. So if they are able to achieve this over in the next 3 to 5 years, then our target price, all things equal, should also see a corresponding revision upwards. But in terms of the pro forma, you can see that the revenue and EBITDA will surge from the acquisition. When we look at pro forma financial year 22 results, what pro forma means you assume that the acquisition was completed in FY22 rather. Then you can see that instead of 1.2 billion of revenue, you will have $3.8 billion in revenue. So more than 3 times. EBITDA will also go to 445 million from 94 million. And your earnings per share, assuming that the rights issue is fully funded by rights, you can see earnings per share is also accretive at 3.2%. 3.2 Singapore cents versus the 1.8 Singapore cents rather. In our next slide, in terms of the second investment thesis, we like SATS for its strong cash flow generation and defensive balance sheet. SATS has historically has had a very strong free cash flow generation. We believe this will support its dividend payout. When we look at the second quarter 23 results, the second quarter 23 would have been near break even already if we remove the $15 million of one-off WFS acquisition expense. So if you look at this chart here on your right hand side, you can see the key metric that we are looking at is actually the core PATMI ex relief. So why core PATMI ex relief? Because SATS was one of the sectors that was adversely affected by the COVID-19, and so as part of the government's rescue package, they actually received government grants and reliefs to help it to tide through the crisis to maintain core capabilities. So what SATS is trying to do now is to try to move this core PATMI without the reliefs to positive. So it means that they are profitable without the reliefs. If you look at the number here below, with reliefs, they are actually profitable. They have a profit of $9.8 million. But without the reliefs, then they are negative. But what we are trying to say here is, as you can see the company on a year-on-year basis actually trimming the core PETMI-X release. So we believe that they will start to turn profitable actually by the second half of our financial year 23. We provided this chart here below. You can see we expect the SATS to turn profitable by fourth quarter 23, reporting a $400,000 profit, and then to be fully profitable by FY24. So the key risks are integration challenges for WFS. Naturally, we see the $100 million of EBITDA synergies identified over the 3 to 5 years as the key metric to watch. So for us, we believe the main challenge is how the company can realize these synergies over time. That would be the key to watch. But having said that, our target price here, we already excluded the thing. So even if we assume a worst case scenario that they don't realize these synergies, we still believe that it is currently still undervalued. With that, we initiate coverage on SATS with an accumulate rating and a target price of $3.02. We value SATS at 80.5 times FY24 earnings, which is one standard deviation below its historical range. We view SATS as best in class with a defensive business model and superior growth profile. We believe SATS is at an inflection point and is turning profitable and model break even by second half financial year 23. We also expect the group, we think the shareholders will like this, to resume the payout of dividends by FY24 as the group reverses back into profitability. So that's all for me for SATS. My next counter is on Sembcorp Industries. So Sembcorp Industries announced the another acquisition that followed these earlier acquisitions. But for us, the key main takeaway from this acquisition is the company actually ruled out the equity fundraising for the deal. So in our next slide, SCI announced the acquisition of another 830 megawatts of renewable assets in China through a joint venture with State Power Investment Corporation. So State Power Investment Corporation is actually a state-owned enterprise, and they actually hold NIO Energy, which owns a portfolio of wind and solar assets. So the total equity consideration is RMB 1.1 billion or 204 million Sing dollars. So they are acquiring about 43% stake in this company. So NIO Energy, State Power Investment Corp or SPIC will still hold the majority, over 50% in NIO Energy. Importantly, the acquisition of Xingling will be accretive to earnings. The completion is expected in first half 23. No financials were provided, but the management say that the acquisition will be funded by debt, a combination of debt and internal cash flow. The acquisition will also diversify the group's presence from the northwestern part of China to the more central parts of China. And the IRR of the project, while not disclosed, we believe to be at about 11 to 12%. Because these are fairly new assets, so we believe the IRR of the project is largely in range with the others, 11 to 12%. That means that we expect break even in 5 to 6 years. Acquisition of NIO Energy will also bring the group's gross renewable energy capacity to 9.4 gigawatts. So this 9.4 gigawatts puts it at touching distance to its 10 gigawatts of target that they previously set. So we believe the group will announce a new revision, because they are only 0.6 gigawatts away from their target in 2025. So we believe they will announce a new revision probably in their full year 22 results when they take stock of what has happened, because they are close to hitting their target already, and they are way ahead. But importantly, last but not least, management ruled out equity funding. So the fear of equity funding was what we believe drove the share price down, but management actually ruled out equity funding to finance the speed of acquisition. So they continue to affirm that to hit 10 gigawatts, they will not be doing any equity fundraising. In our last slide, in terms of outlook, shareholders have approved the sale of Sembcorp Energy India Limited sale to Tenway Infra Fund. We believe that management will further deploy the proceeds to grow its renewables portfolio to beyond its 10 gigawatts gross renewable energy target. In terms of recommendation, our earnings and core is unchanged, while our target price is still maintained at $3.68, still based on 1.2 times FY23 price to book. So that's all for me for Sembcorp. I'll hand over the time now to Zane.
Thanks, Terence. I'll now go through the technical analysis section. So for the Straits Times Index, last week we started to pull back after we tested the key 3,300 resistance level. So for this week, we expect the pullback to continue, with the immediate support being 3,140 to 3,180 area, which is the confluence of a 30.2% to 50% Fibonacci retracement level, to possibly fill the price gap, and as well as a retest of the key uptrend support line that has been holding the index since the 2020 bottom. For S&P 500, there's a possible continuation of the bullish momentum to test 4,100 level. So the immediate resistance is at 4,000 to 4,130 area, which is the confluence of the uptrend channel resistance, the key downtrend resistance line acting on it this year, and the 61.8% to 78.6% Fibonacci retracement levels. For the immediate support wise is at 3,008 to 3,009 area, which is the uptrend channel support, as well as the 30.2% and 50% Fibonacci retracement support levels. For individual counters, we have 3 of them. The first one being CapitaLand Investment Limited. So for this, we have a technical sell at $3.62. The take profit levels are at $3.25 and $3, with the stop loss at $3.82, and the stop loss close at $3.63 on Friday. So for CapitaLand Investment, we see a potential pullback of the recent rally to retest the 2 support zones at $3.25 to $3.40 and $3 to $3.10. So the reason being, the price formed a bearish reversal evening star pattern on 18 November at the 360 to 380 resistance area, and that is confirmed with a 61.8% Fibonacci retracement level at $3.68, and we use a recent swing high of $4.10 and a swing low of $2.99. Also, looking at the technical indicators, the MACD is currently displaying decreasing momentum, with the RSI reaching a reading of 70 and overbought level, which signals for a bearish signal. With that, the price could retest the first support zone at 325 to 340 to fill the price gap, and continuation of a bearish momentum could see a retest of the next support zone at $3 to $3.10, which is the year low support level. For this counter, our institutional research has a fundamental recommendation of accumulate and a target price of $4.12, just to take note. So the second counter will be Franken Group. So for this, we have a technical sell at $1.07, TP at 98.5 cents, stop loss at $1.11. Stop loss closed at $1.19 on Friday. So they hit our stop loss and the trade was invalidated. So for Franken, last week, we saw it was likely to see the stock price continue moving lower to retest the uptrend line support. With that being, the price had traded sideways since retesting the previous support, now turned resistance at $1.12. Also, there was a bearish engulfing candlestick close on 21st November with the MACD momentum decreasing. With that, we thought the price would move lower to test the uptrend line support. The last counter will be ASML Holding. So for this, we have a technical buy at $596.21. The take profit level is at $700. The stop loss at $568. The stop loss closed at $591.84 on. For ASML, it's likely we see follow through of the bullish momentum to drive the price higher to retest the next key horizontal resistance at $700. So the reason being, the price formed a bullish consolidation pattern following a breakout of the long-term downtrend channel. So with that, we are likely to see the follow through of the bullish momentum to retest this $700 key resistance level. So that's all from me for the technical analysis section. I'll now pass on my time to Sean to talk about the Fed minutes.
Yep. Thanks, Zin. I'll be going through a rough highlight on the Fed minutes that was released last Wednesday. Just a recap, the FOMC have suggested a fourth consecutive 75 basis point hike, and there were no dot plot projection that was released back in November's meeting. So in this November's minute, the committee have mentioned that despite a slowdown in October CPI numbers, labor demand still remains relatively strong, and labor market continues to be really tight, very tight. Personal consumption expenditure, which is the PCE, which is also another indicator used by the Fed to measure inflation rate, still remains elevated, with the headline PCE standing consistent with August measure inflation, released at 6.2%, and core PCE, which exclude food and energy prices, on the other hand, have increased from 4.9 to 5.1%. With that, we can see that inflation is still not slowing down, and it is still higher than the Fed's target of 2%. Despite unemployment edging up from 3.5% in September to 3.7% in October, the increase in unemployment rate is still not rising as what the committee have initially expected, but with recent slightly positive data points, members of the committees are hinting towards smaller rate hikes in the upcoming December's meeting. Moving on to the outlook, the projections for the Fed still remains relatively weak, but the committee is expecting a loosening of the labor and product market going forward. However, the Russia war in Ukraine, headwinds in China, and potential tighter financial conditions still remains to be the downside risk to committee's projections. Additionally, if the inflation remains to be persistent, the committee have mentioned that a greater than assumed amount of tightening will be required, as they believe that the Fed's target policy needs to rise to at least roughly around 5% next year to be considered sufficiently restrictive. So some of the key comments made by the Fed officials like Christopher Waller, who said that he is more comfortable with smaller rate increases going forward after a lower than expected CPI release, and Loretta Mester, who said that she thinks a slow down from the aggressive 75 basis point at the next meeting would be very appropriate. All this indicates that it is very likely that we'll be seeing a slower rate hikes 2 weeks from now. But although we might be experiencing slower rate hikes moving forward, the Fed still remains firm in bringing down inflation to their targeted range of 2% with tighter monetary policy. So unless there are more positive data points indicating that inflation is slowing down, we can be sure that the terminal rate will at least be around 5% or even higher around the second quarter of 2023. So one of the days to note down this week would be 1st of December, which is this Thursday, where Jerome Powell will be giving his speech on his views, and there will be a release of PCE numbers. So this will better provide clarity and affirmation for the upcoming meetings. On the next slide. So this chart is basically a correlation chart between the Fed funds rate, which is the blue line, and our Singapore 6 months T-bill rate, which is the red. So on this chart, we can see that although it is not 100% correlated, but both lines does experience similar movements, be it increase or decrease. So this further supports that if the Fed is continuing to raising their rates and climbing up to a rate of like 5% next year, we can expect our 6 months T-bills to move in tandem. However, do note that this is just an approximation, and T-bills, the yields are subjected to market forces. So yeah, with that, that's all we have for this week, and we can move on to the question and answers.
Yeah, I think I'll take the first question here. There's one question on what's your outlook on the Santa Claus rally for this market. Sorry. So we think that it really all depends on a lot of your macro indicators like inflation, like PCE and such. there is still quite a lot of weakness in the market, so it may not be there may be a Santa Claus rally, but it probably would not be as large as what we've seen in the past. But if you also there's the Fed meeting on the 13th and 14th of December. Everybody expects a 50 basis point rate hike. I think if you do start to see some easing in terms of inflation, that could be one of the catalysts that would drive US markets up. At the same time, there was some indication of consumer strength with the latest, Black Friday sales that were record sales. So there are parts of the parts of the economy that are still relatively strong. It just needs something to kind of spark, or at least the market just needs some sort of catalyst to get it going. Because I guess for the last for most of this year, it's been really bearish so far. I guess that's all for me. Thank you.
Yeah, I'll answer the question on the data center REIT. Most of the data center REITs have decreased a lot. Can you share our latest view? Also, which REITs are good buys and caution to take? So yeah, most of not only the data center REITs have decreased a lot. Generally across the whole REIT market, all the share prices got bashed down quite a bit. So they are still quite low. And for the data center REITs in particular, because of the current environment, a lot of the data center REITs, they tend to use acquisitions as a way for inorganic growth. It's one of their key, their so-called inorganic growth prospects, as compared to like hospitality sector where they can have a lot of organic growth in the RevPAR recovery. So for data center REITs, we are not bullish for data center REITs at all. And which REITs are good buys and any caution to take? We are more bullish on the hospitality sector, like Ascott REIT. Like I mentioned, because of the recovery in RevPAR. The other REIT sectors out there are not doing too good, especially with the interest rates. Like they say slower, but the higher terminal rate at the end of towards the end of 2023. So yeah, so for REITs we are really not too bullish. Yeah, so that's just a short answer for that. I'll hand over to the rest of my teams.
Yeah, probably take over here. Hi, Terence. Is SATS acquisition of WFS subject to any regulatory approval? If yes, what is the chance of it being approved? Yeah, so that's a very good question, right? Yes, so the answer to the first question is yes. The SATS acquisition of WFS is subject to regulatory approval. The reason is because the WFS is already a world leader in the gateway services market in terms of cargo, and they hold number one positions in some of their markets like the US and Europe. So the acquisition of WFS naturally would require regulatory approval. In terms of what is the chance of it being approved, yeah, so we cannot say for 100%, but what management say is that as part of its due diligence process, they actually engage international lawyers from around the world to look at the deal, and according to the view of the international lawyers, they are of the view that the acquisition would not see any difficulty getting regulatory approval. So they do expect that the acquisition would get the regulators nod. Yeah, but that's a good question. Thanks. Let me see. I'll take the other question on CSE Global. What's the outlook of CSE Global? Price keep dropping. Yeah, so the reason why for CSE Global the prices have been dropping is because of the rights issue that they have announced that they'll be doing, and so that has caused an overhang on the share price, and so you start to see prices continue to drop. Yeah, but we've got no coverage now. But we believe the overhang of it is because of the rights issue. Yeah, I think that's all for me. I'll hand over the time back to the rest of my team.
Okay, maybe I'll just take over and do the technical analysis section. So let me share my screen. Okay, so Hang Seng Tech. So for Hang Seng Tech, looks like last week after we hit the resistance area over here, the recent swing highs around 3.65 to this swing low resistance at 3.8. We had a pullback over here. So for now, looks like we are back testing this downtrend resistance line over here. So that's at the support around 327 over here. So I think the lower end of the support could stretch this swing lows over here around 3.15. So as long as it's over here, we find support, we might do a bounce up to continue with this recent bullish momentum over here. So as long as these swing lows over here, around 3.14, 3.15, we find support, should be okay to see the bullish momentum continue. The resistance ones will continue to be this recent swing highs over here. That's about 3.6 to about 3.86 over here. Then Ping An also broke out of this downtrend resistance line recently. Then it found resistance around the $44 mark, which was the previous support turn resistance. So last time it was support around in September of this year. Then after it broke down over here, we did a retest and it became a resistance. So we tested twice and then we had a pullback over here. For now, the immediate support will be at this level here, around $40 mark. So today we touched a little bit just shy of it. So for now, it looks like the bullish structure over here still remains. But with this, looks like we could possibly do a range trade for now, unless we break $44. That could see the price hit to the next key resistance around $47. So for now, bullish view still remain. Look for more price action to confirm maybe it's a consolidation move or to continue to move higher. Okay, then for Tencent also similar story, broke out of the downtrend resistance line over here. Today looks like he hit near the support zone. So it's about, today the low was about 259 over here, which was this level that we broke out from. So we did a test today. So the bullish structure still remains. But if we go lower, the next key support level could be around $245 here. So if some bearish momentum continues, we could see this level. But for overall, for now, we're still forming higher highs and higher lows in this stretch. So the bullish outlook still remains, with the key resistance level being around the 300 mark over here. So the swing high generated over here, which was a previous support level over here that broke down from. Okay, for Hoppa. So for Hoppa, the downward momentum still remains strong, but recently we did a rebounds to form a higher low over here around 925. So let's see whether it can retest this 970 to 980 swing high over here and 985 resistance level over here. So I expect another retest over here where we could find resistance, and if we do continue to find higher lows along the way, this could be an ascending triangle over here. That would set the stage for some potential bullish reversal for Hopper. If not, if we see continued resistance and this swing low breakdown, then the bearish momentum, the overall long-term bearish outlook will likely remain for Hopper. Okay, then Maple Tree Peninsula commercial. Okay, so this one after the double bottom support over here around 152, he had a rebound over here to hit around 177, which is the 61.8% Fibonacci retracement level when you take the swing high of around 193 to this swing low of 152. Then this 177 also coincides with this swing high resistance over here back in early October this year. So after we hit this resistance, we are having a pullback over here. For now, the immediate support could be at this 165 level. So this 165 was a resistance over here that we managed to break out from. So currently we might be doing a retest. Let's see whether some bullish candles comes in to show that it's a successful retest and the price could continue to move higher. If not, if we break this 165 level convincingly, we might head down to the next level around the 160 mark. And the lower end of the support will be near around the 153, 154 area over here. So that's for Maple Tree Peninsula. Okay, then JD. JD.com, recently we hit this resistance over here, this swing high of around the 227 mark. Then we saw a pullback over here. So currently, I think the first support level to look out for is around this level, around the 180 mark, which is this level that we broke out from over here. So let's see whether it does a retest of this level to show some buying coming in. If not, the next level to watch out for will be around this swing low, around the 165 level over here. For now, the bullish structure still remains, but this is not as strong as the previous Hong Kong counters mentioned earlier, because in this pullback over here, the 195 level was being breached, this supposedly higher low over here. So we must recover this level quickly for the bullish momentum to continue for JD. If not, we are likely to see it come down to this next swing low around 165. Okay, Alibaba. So Alibaba, recently, now what we are doing is a retest. So after hitting the resistance area, a key resistance around the $80 mark. So we hit around 83.50, just short of this swing high at 84.50, around 84.50 over here. Then we pulled back to retest this key resistance level at $71. So this level we broke out over here. Currently we're doing a retest. So the bullish momentum, bullish outlook still remains as long as this 71 can hold. If not the next resistance, if not the next support, sorry, would be at $67, the next swing level to take note of. Okay, then for Hong Kong Exchange, so recently we had a rally over here, but it was a little bit short of this key previous support and resistance area around 318. Then we started to pull back. We also broke this was the previous resistance last time that we broke out of. So that's around 280 to 285. Currently we are after a retest over here, we went below it. So that's a little bit shows a little bit of weakness in Hong Kong Exchange. So if this 280 to 285 shows continued resistance, we might see some continued bearish momentum to retest this swing low over here at 249 over here. Yeah, so we need to see whether it can claim back this zone in the coming few days. Then we could see move up to test around 310 over here again. So that's for Hong Kong Exchange. Okay, AEM. So AEM, after the sell down over here, starting to rally, do a bounce over here in this region. So it formed the ascending triangle, managed to break out. Then we form a higher low over here, then from a higher high in this recent stretch. So now we are currently pulling back a little. So today we tested this resistance over here, around 365. See whether there's support coming in to continue from a higher low to continue move up further. So overall, the bullish structure over here still remains intact as long as this 346 low higher low does is supported. So for I expect the resistance to be near around the 390 to $4 mark over here. So actually AEM over here broke down on this wedge structure over here, which caused the sell down over here. So now we could see a continued bullish momentum, could see a retest of this 390 swing low over here, which now will become resistance, as well as the $4 wedge, this level over here. And $4 is also a psychological level as well. And it also meets with this 61.8% retracement level from this 464 swing high to the swing low over here at $3.03. So that's for EM. ESM Pacific Tech. So this one still for now there was a bounce recently also. For now the bullish structure still remains good. Because after the sell off here, then we consolidated at the lows over here, then we subsequently broke out again. And what we are currently doing now is like a range formation consolidation move. So there was a swing low over here at around 54.90, and we retested it today. Saw buying coming in, so that's a good sign. So currently the immediate resistance will be at this swing high 58.70. So you might do a retest and continue to stay in this range for now. There's also strong resistance at 59.60 over here. So there was a previous support level over here. So we could retest it and that could become a resistance. So I expect some range movement up over here, but could face some resistance right above in the near term for ASM Pacific. Okay, then UOL. This one recently tested the previous support zone counter resistance area. So this zone is at around 660 to 675 area. So previously, there's time they had two swing lows support. We broke down over here and we did a retest back in the middle of November. Currently, then face resistance and pulling back. So for now, overall, this one is still like bearish because previous support turned into resistance over here. For now, the support will be around this, around the 630, around 640 level over here. So this resistance that break out from a retest over here might offer some support. If this doesn't hold, then it will become this swing low over here around 612, which is also the wedge support. If you look at the long-term picture for UOL, there's a wedge support over here at around 612. So I think for now the bearish outlook still remains until we can close above this 675 level convincingly and move higher. Okay, then Wilma. So recently there was a move up, and currently looks like we could possibly be consolidating in a descending triangle pattern over here. So the neckline is at 403. So 403 is a key level to hold for the bullish momentum to continue. If not, the next immediate support will be around the 397, this horizontal level that you broke out of over here. For now, upside looks like might be limited because around the 423 mark, there's a 2 swing highs resistance last time. So for now, I think the upside will be kept over here, which is also a 61% retracement from the highs of 470 to the low of around 346 over here. So expect some resistance around this area. For immediate support will be this 403 and then around 397 level over here. Okay, then Capital DC. So this one is currently in this downtrend channel over here. So the bearish outlook still remains inside this downtrend channel. For now, the resistance at this red color zone, which was the previous support. So that's about around 182 to 190 area over here. For the immediate support wise, for now will be this swing low made around 177. But if we breach it, it could come down to the next swing low around near this 169 mark over here. So that's for Capital DC. Okay, CapitaLand China Trust. So for this one, the bearish outlook still remains because just did a retest and we had rejection over here. So last time over here around the 105, 106 level, it was a support, swing low support. After that, we broke over here, then did a double bottom over here, managed to retest this previous support, now-term resistance at 107. So this 107 level also matched with a 61% retracement from this swing high 117 to the swing low at 93 cents. Currently, we are pulling back over here. So I think for now, the pullback will extend further to retest this previous resistance over here. Now possibly will act as support at 98.5 cents. So if this finds support, then we might see a bounce over here for CapitaLand China. DFI. DFI, the bearish outlook still remains. So after this sell down, there was a bounce wave over here. So it tested the previous support, now-term resistance over here at around 255. Currently, we see a little bit of pullback. So for now, I think the support could be around this around 226 level, which was a swing low support last time, and then a swing low support over here. So that's for dairy farm. Could see a possible continued retracement to test this 226 swing low over here. Okay, First Resources. And First Resources, there was this uptrend channel that over here that managed to break up over here with this bullish candle. Then we also broke this resistance area around 153 to 159 zone over here. So that will become if we do a back test, that will become a immediate support for First Resources. Currently looks like it's consolidating with the decreasing volume, and like just could be a back test of this trend channel over here. So still a wait for maybe another bullish candle over here to see whether the upside can continue. Then around 180 will be the next resistance mark, which was a previous resistance level back then, and around the 50% Fibonacci retracement level to know. Okay, Samudra shipping. This one looks like near term could be bearish because in the still remain in the downtrend channel despite there was a closing above it, but subsequently we saw selling down over here. Then there was a rebound and continued selling took place. So for now, I think we could be kept in this downtrend, continue to be kept in this downtrend channel with the nearest immediate support around the 91 cent mark, which is this swing low, and the resistance over here that we broke out of. The lower range of the support could be around 86 to 87 cents, this swing low over here. So that's for Samudera. Okay, then Yangzijiang Shipbuilding. So this one, recently we did a retest of this swing high resistance at 142 over here. We hit about 144, just missing a bit of the around 145 to 146, which is the key trend line resistance for Yangzijiang. Currently we are seeing a little bit of pullback, so this could be a double top swing high over here. The immediate support would be at around 135 mark. So that's this wedge line over here, and maybe to stretch about 132, which will be the wedge trend line support over here at 132. So for now, we might see some maybe a range trading for now for Yangzijiang, given that tested this recent swing high resistance, it might come down, pull back to test the support swing low over here. Okay, Parkway Live. This one, the bearish structure remains. After it broke down of bigger head and shoulders pattern over here, we see like pullbacks. But what we see also is lower highs being formed over here as well as lower lows being formed over here. So the price action still shows bearish momentum in. So for now, swing low at 379 could be the support, but we could possibly retest this 367 swing low over here, while the key resistance over here for now will be around the 415 level, this swing high over here. So I will expect possibly the share price to continue to pull back to test this swing low at 367 in the near term. Okay, ComfortDelGro. So ComfortDelGro is like in a downtrend, in this like downtrend channel over here. So after the sell down over here took it to the support, this channel, it kind of just consolidated over here. The lows being around 123, and then the highs at 126. So you see whether it can move back up within this channel to stay in the channel. If not, the next support level would be at around the swing lows last time of 120. So that's the next support level for ComfortDelGro. if it breaks down this 123 level. Okay, then SEM Industries. So this one was a range, like there was a bit of a range trading over here, but recently the resistance over here 313 was being cleared, and today there looks like a bit of a hammer candle being formed over here. So with the higher low over being formed over here as well, that could be signal some possible continuation of the upside momentum for SEM Industries. So if you manage to break this 324 swing high, I think the next level we could see is around this next level around 332, which is this swing high over here, as well as it was a previous resistance last time. It's a previous support that could act as a resistance for Sembcorp Industries. So for now, the bullish outlook still looks pretty good with this price action that's taking place over here in this stretch. Okay, Best World, we broke out of this like downtrend resistance over here, but the immediate resistance is quite near over here around the 180 to 188 level. So there was a 2 swing highs over here, and where is the resistance over here. So for support wise, it will be this level that we broke out from around the 172 level over here. So that where is an immediate support for Best World. Okay, China Aviation. This one for now, the bullish momentum could continue. Given that last time this around the 70 cents mark is a key level, we broke down over here, then we recovered back up over here. We did a higher swing low over here, which was supported. And then when the price pulled back over here again, it was supported again. So it shows that this previous support turn resistance can become a support area again, which could drive the stock to possibly retest this swing high around 79 cents, this level over here again. So for now, could see this retest of this level at 79 cents. With the support being around the 71 cents mark. Okay, then StarHub. StarHub looks like after the sell down, looks like it's consolidating sort of like a possible ascending triangle over here. So the resistance is 108. For the support will be around possibly 103 to 104, this swing over here. So we need to see the next move, whether it's a breakdown or a break up, to decide the next direction for StarHub. Sorry, yeah, we need to wait for more price action to come in. Okay, TA for ST Engineering. Okay, so this one, after the sell down, looks like it was in an uptrend channel over here. It went out a little bit over here, but looks like for now the price is like in a small range. So the support over here 343. Then the resistance is at 351. So you see whether we break out of this range. If we move higher, then the resistance is at around 356, this swing high, to about possibly near 360 mark, which is the 50% retracement level from 407 to 312. Then if we break this 343 level support, I think the next level we will see is around 337, around 334 to 337, this previous resistance over here. And it's also a 23.6% retracement level for ST Engineering. Any?
Sorry, maybe I just cut in here because there's a question on ST Engineering before I pass back to you, Zain. Yeah, so I think there's a FA question also. Hi, what's your thoughts on ST Engineering, which just announced their financial results? Yeah, so they only, because this is a third quarter FY result, so they only announced the revenue, but revenue grew very strongly by nearly a fifth. So the results were very strong across the board. I think one of the things that we were looking out for, especially, was their aerospace segment, which grew in line with the travel recovery. So that was actually a bugbear. So we think the recovery there is good. The second thing is the divestment of the US business, loss-making business, which they will dispose of by FY23. So that is good because that will improve their profitability. The third thing that we looked at for ST Engineering, obviously, was their order book. Their order book at $25 billion is about 3 times of their full year 22 revenue. So when you think about that, their full year estimated revenue. So when you think about that, the order book will easily sustain them in the next two to three financial years, and that's expecting that. Estimating that their order book remains stagnant, it already account for 3 years of their FY22 order book. So we think the outlook continues to be positive, but obviously the main risk for ST Engineering is the exposure to the commercial papers, which is affected by the higher interest rates now. But generally, overall, its business is still good. Yeah, I think that's all. I'll hand back the time to Zain.
Thanks, Terence. Okay, I'll continue with TA for micro mechanics. So this one, from the long-term picture, it looks like it remains in a bearish structure. So there was a long period of consolidation over here around 280, 317 level over here. Then we broke down over here in October. So what we're doing recently is like a retest of this previous support, long-term resistance at 280. So I expect the share price to come back down to test this around the 244 support over here. Given that the overall structure is bearish, and then we couldn't break through the 280 mark at the second time of testing it also. So possibly we'll see 244, this swing low support sometime next time if we do retest this level. Okay, UMS. UMS still looking pretty strong. So there was this long-term uptrend support line for UMS, which we broke down over here, but we managed to reclaim it over here with a strong rally. So currently looks like we are just doing a little bit of consolidation over here at around 122 to the 128 level. So the resistance is around 128 to this swing highs at 135 would be a rather strong resistance over here. So we could still see the price continue to move higher as long as this 122 support moves. Then the support could stretch down to about 116, these swing lows, as well as this trend line support over here. So that's for UMS. Okay, SIE is the next one. Okay, SIE is like near the resistance zone for this wedge. So there's this wedge pattern over here, a big one. Then over here, there's a key strong strong resistance also at 550 to about 558. So over here we expect some resistance over here, but for now looks like it's doing a little bit of a consolidation over here. So the swing lows around this mark at 542 over here, the support. So if this doesn't break 542, there's a chance that it could be doing a build up over here to challenge this resistance. That could mean for a possible breakout of this big wedge pattern. So 542, this level, this support level is something to take note of. If we do break, then we could come back down to around 533. This level over here. The lower one will be around 523 to 525 level. These swing lows. Okay, Sheng Siong. Okay, Sheng Siong remains the long-term outlook still remains bullish as sitting nicely in this uptrend channel. Today what it did was retest of this swing high resistance at 167. So expect some resistance over here 167 to the last time there was a swing high over here around 169 also. So this range could expect some resistance for Sheng Siong. Okay, then while we pulls back, the support could be at around 160 to this 163 level over here. So over here within the channel, you can expect some support over here for Sheng Siong. Asia Cement Holdings. Okay, so this one, the long term is quite bearish. Just like declining over time over here. So I think the outlook is still rather bearish. For now, the previous support over here around 315. After we broke down, we came back up above. So then we did a retest over here, which was successful with the buying over here. So this will be the immediate support for Asia Cement. The resistance will be the swing high over here around 342. So as long as this doesn't, sorry, as long as 315 holds, we could possibly see a retest of 342. Then the next key level will be around 373. This swing high over here, which was a previous support long-term resistance also. But if this 316 level doesn't hold and breaks down, right? Then I think it should be cautious. It will come back to test this swing low around 274. Given that over in this stretch we see lower highs being formed as well as lower lows being formed. So high chance if this support doesn't hold, we will see the retest of this swing low over here. And given that the overall structure is still rather bearish, I think that's quite likely as well. Okay. Singtel. So for Singtel, recently after it did a double top around this 276 level, it was a slight dip, but it was still supported around 268, which was this swing high over here. So it's still rather strong. We could be doing some little bit of consolidation over here, maybe in the range to maybe or before continuing the bullish momentum higher. But if this 267, 268 level is broken, then the next level to watch is at around 264, which is another level over here. Then the next key level will be around 260 over here. So that's for Sheng Siong, Singtel. Okay, SATS. Okay, SATS, after the big sell down over here, is like currently consolidating in this wedge over here. So the volatility is shrinking. So let's see whether the direction, it needs to choose the direction in a bit more time. So let's see whether it managed to break up to form a reversal over here, or it continues with the bearish momentum to move lower. So for now, the support is around the low end of support around 252. Then I think the wedge support is around maybe 260 over here. Then so for the resistance wise, is around 274, 275 level. This swing high resistance and the wedge resistance over here. So that's for SATS. Okay, then for I2. This one, for now, it still looks bullish. So what it's doing is that it's like consolidating in the range. So after the recent sell down, it looks like it did a retest, okay, which fell a little bit short of this swing low over here. Okay, but we did retest this previous support over here at around $97. Then for now, it's like doing a consolidation range over here with the support being around 87 and the resistance around 97, 98. It's also a good sign that this previous resistance level over here that broke out of, the retest over here was successful. So generally still a bullish signal. So as long as this 87 doesn't break down, possibly see 97, 98 retest again, then this could be a bullish consolidation range for some further upside for Python. JD Logistics. So this one not as strong as Python because there was a previous support zone over here. So that's around $13.90 to about $15 over here. What recently did was a retest over here. Then it subsequently pulled back rather fast over here. So I would expect the support could be at this swing low around 1150, 1160 area. Then followed by this recent swing low at around near the $11 mark. So for this expect selling momentum over here is rather strong, so that could continue to retest these two swing low levels. Then the resistance will remain at 13.90 for and around $15 over here. Okay, then Meituan. Meituan also like similar to J Logistics, a bit similar. It's not as strong as Baidu because over here, this previous support level was around the 160 to 165 zone over here. We did a retest and then we subsequently pulled back down over here rather fast. So I expect there's a chance to retest the swing lows over here, which is around 112 to about 120 levels over here, and to possibly form a range trade. I think resistance will remain at 165. So for this, expect some range trade to come in for Meituan. think I'll just take one more. Okay, there's 2 questions more. 2888 is a stand chart. This one is looking at the long term over here is like some bearish structure over here, but recently doing a rebound. So recently rebounded to about 55.60. So expect if the run continues over here, we could see around the 57 mark over here, which is this swing high resistance over here. Given that it's forming like a gentle bounce uptrend over here. But if we do come back down, the immediate support will be around the 51 to 52 level, which is the resistance that was being broken over here, and previous swing low support over here. Then the lower end of the range will be around $47 over here. So the rebound could continue to test 57, but overall the structure is still rather bearish over here. Okay, then Raffles Medical. In Raffles Medical, for now, I think there's a potential bullish cup and handle pattern in the making. So that's actually a bullish sign. So I would think that as long as this it can stay above 128, right? This key level over here during this pullback, then it subsequently break out, then it's a good sign. So for now, the 120 to 131 will be a key support level for Raffles Medical. Then the resistance wise, the strong one will be at around 140, these swing highs to the swing high of 145 over here. So this one still awaiting for maybe more price action to determine whether this is a bullish cup and handle or not. Yeah. So that's all from me. I'll pass back my time to my colleagues.
Yeah, I'll take the question on the REITs. For REITs, you are not too bullish. You said for those who are holding for how long? And with the recovery, there will be a recovery for Parkway, Frasers, and Mapletree Lock. Yeah, so for this, for how long will the sentiment be down? I mean, we can't really say. Hard to say. If I knew, I'll be retired by now. So, but we think it will be in around middle of the year next year. Yeah, so around June like that. That's what we think will be recovery. And will dividends be affected? I mean, because for inorganic growth is quite hard. So making any accretive acquisitions is really tough in this environment. So the only growth factor here is organic growth. So the dividends, we don't think will be affected that much, but maybe it will be just be flattish. Yeah, not much growth in that aspect. But for acquisitions, we do see a lot of the REITs going into Japan because of the low interest rate environment and the stable cap rates. So that's the only place where we see acquisitions. Yeah, and we think the recovery will be when the Fed actually decides like when the rates peak. So that nobody will know when. So yeah, we think it'll be probably the middle of next year. Yeah, I think I'll pass on to anyone else. If not, yeah, we can probably end the session already. Yep.
So thanks everyone. Paul is on leave today, so won't be able to take the rest of the questions. So I think we'll just end the webinar for today. See you all again next week. Bye.